If you've ever tried to learn how to trade Forex and got overwhelmed within minutes, this video, I am going to simplify everything for you. I've been trading for the past 5 to 6 years, and I am going to break this down in a way that actually makes sense for a beginner. By the end of this video, you will understand how Forex trading works, how to read the chart, and how to actually start making sense of the market. And in the next videos, we'll be able to build on this so you can actually begin to execute with confidence. And this is only part 1 of the beginner series where I am breaking everything down step by step. So before you continue this video, go ahead and grab you a pen and paper, because if you don't, you are already setting yourself up to fail. Let's get into it. So to start, what is Forex trading? Forex trading is the process of trading one currency for another. Forex is only short for foreign exchange, the foreign exchange market. Now, a fun fact about the foreign exchange market, it is the largest financial market in the world. And the daily trading volume in this market is $6 trillion daily. So just know opportunities is going to be coming at any and every given moment. In Forex, you are trading currencies, and those currencies are being traded in pairs. So for example, you're going to see currency pairs like the euro dollar over the American dollar, euro USD, or the Great British Pound over the Japanese yen, GBP, JPY. Do not let that throw you off. We will get more into it later. How do you make money from the foreign exchange markets? The profit comes from the changes in the exchange rates. So you buy low, you sell high, and you're selling high and buying low. This will make more sense as we continue into this series. Why should you start trading Forex? Well, first of all, it's open 24 hours a day, 5 days a week. We're going to say 5 days. I would say 7, but let's just be realistic. We're not trading on the weekends. So 5 days a week, the market is always open. This is a global market, so there's different time zones that operate in different time frames, I guess you could say. So regardless, you will be able to choose a time that works best for you. The second thing is this is accessible to anybody with internet. So if you are looking at this video right now, you are able to trade. There should be no reason why you tell yourself you're not able to. You have a phone and you have a computer and you have Wi-Fi. That's all you need. And the most important is that you can start with small amounts of capital. You don't have to have thousands of dollars to get started with this thing. And if you do, of course, the more the merrier. But if not, do not let it be a reason that you are stopping yourself if you have little. How to get started. To get started trading, you need to have a trading plan, a strategy, and a willingness to learn. If you don't have a willingness to learn, you will fail very early on and be one of those people that go around saying that it doesn't work or it's a scam. So starting with number 1, you need to learn the basics. You need to understand key terms like what is a pip? What is leverage? What is margin? The second thing, you need to choose a broker. It is so important to make sure you are choosing a broker that is regulated and a broker that suits your needs. I want to put emphasis and extra asterisk on regulated broker. Just go to Google, type in United States regulated Forex broker or just something along those lines. Just leave the word regulated in the search terms, okay? The third thing, practice on a demo account. Before you risk real money, you need to be testing out your skills and your edge in a stimulated environment before testing with your real capital. The fourth thing, you're going to develop a strategy. You need to decide when and why you are entering and exiting trades. But the key thing to remember here is that trading is not just about making the money, but it's about managing your risk and staying consistent as you are journeying through this skill. All right, so we're about to get into understanding the price chart. So this is pretty straightforward. So what is the Forex price chart? This is just a visual representation of price movement over time, and it's showing you how the currency pairs move. So this is going to be able to help us make a decision on how we're getting into the market based on the pattern that we see on the chart. The one thing I do want you to know is that the chart tells the story of where price has been and where it may go in the future. So it's always giving you clues on where it may go next. What does the candlestick tell us? So each candlestick shows the price movement during a specific time period. So as you can see in this picture, we have 4 key pieces of a candle. We have the open, where price has started, the close, where price has ended, and you have the high and the low. The high being the highest point price has reached, and the low being the lowest point price has reached. So as you can see in this video, you will hear us say wicks, like candle wicks. So the high and low of the candlestick is often referred to as wicks. So that's just important to keep that in mind as well. Now, one thing before moving forward, I do want to let you know, don't fixate on just the candlesticks right now. That's just something for you to know, that there's an open and close and a high and low on the wicks itself. Now, what does the time frames mean? The time frame represents how long each candlestick, how long each candlestick represents. I'm getting tongue-tied. So here in the example, you have the 1 minute time frame. Each candle that you see on the 1 minute time frame is going to represent 1 minute of time that has passed by. The 15 minute, each candle represents every 15 minutes. The 1 hour, each candle will represent every hour. 4 hour, every 4 hours. 1 day, each candlestick shows you what happened each day. Something to take good note of is the higher time frames are the bigger picture, and the lower time frames is just more detail and more noise on what's going on. This will make sense later on, but it is important that you understand that your higher time frames are going to be the key decision makers on when you choose to enter the market in the lower time frames. I don't want to confuse you. I want to keep that simple. Pick a time frame that matches your lifestyle. Do not sit and chase charts all day. Because the market does not close, it is very, very easy to fall into the trap of just sitting at the computer, trying to find opportunity, knowing when the Asian session's coming, knowing when one session's closing and the volatility kicks in. Like, do not do that. In the beginning, you have this dopamine rush of learning how to trade Forex, and you just don't know how to keep your cool. Don't sit at the charts all day. So if you are a stay-at-home mom and you have a busy schedule, you're homeschooling, you start with the 1 hour or the 4 hour. If you have more time to actually just sit and be able to, then you'll be scalping. You'll figure out where you're getting in the 15 and the 30 minute. The time frames matter, but it is so important to pick a time frame that matches your lifestyle, so it's not draining you and you're having poor decision making based on you being tired. So by now, you know that the chart tells the price's story. Candlesticks show what price has done over time, and time frames help you zoom in and out. But you don't need to master all of that right now. You're just getting familiar. All right, here are some Forex key terms that you need to be familiar with. We're going to start with the pip. A pip is the smallest unit of price movement. So the example here is 0.0001 for most pairs. A pip is what the price is going to be moving by. So when you are looking at your pair, the pair can say, 1.2345. And if it goes up 1 pip is 1.2346. I think I'm saying that right. I'm getting the numbers mixed up in my head. But the pip is literally the smallest price movement. A spread. The difference between the buy and the sell price. It is important that you know that. Leverage. Highlight leverage. This is the trading power that lets you control a larger position with a smaller balance. Oftentimes you hear people blowing their accounts. It's due to leverage power. Some people over leverage what their account can handle, and literally one price movement can cancel out their whole account. So please be sure that you understand what leverage is. Lot size. This is the size of your trade. There's micro, mini, and standard. Based on what your account is, this is, you'll align with what lot size you need to be trading. Stop loss. This is the risk management tool that closes your trade automatically at a set level. So once you calculate your risk, a stop loss, you should not be getting in without a stop loss. If you do, you are already setting yourself up, but we are not going to get into that right now. I want to keep this as simple as possible. Take profit. This is a tool that locks in the profit automatically once your target is hit. So for example, if your goal is to make $150 a day, and your goal may even be smaller, like $10 a day. Once price gets to that and you see that you have $10, you will set that as your take profit and it'll automatically take you out. So it'll automatically take you out of the trade. Now, bullish and bearish. It took me a minute to understand the difference between the two. So I had these two words pinned on my laptop at the time. Bullish is when price is expected to go up, and bearish is when price is expected to fall and go down. It's going to take you a while to understand the difference between the two if you learn like I did. Support. This is where price tends to bounce up, and we'll learn more about that later on in this video. And resistance is a level where price tends to reverse or get rejected. So now we're going to move into understanding currency pairs, major versus minor. These are the two main types of currency pairs. So this is, once again, you're trading one currency against another, like it's a tug of war between two economies. Major currency pairs, these are the most traded currency pairs in the world, and they all include the US dollar and another major currency. So think of them as like the main characters in the industry, because they're just the main characters. It is what it is. These are very popular, and you may have heard these before, and if not, it's okay. I'm going to teach you about them now. So if you take a look at this list, there's Euro USD. That's the Euro dollar over the US dollar. GBP USD, that's the Great British Pound over the US dollar. USD JPY, US dollar over Japanese yen, and so forth and so forth. Why do we trade the major pairs? Well, they usually have lower spreads, which they're cheaper to trade, high liquidity, which is lots of money, and they move more consistently. And these are perfect for beginners. As a matter of fact, right now, Euro USD and GBP USD, write that down, highlight it, star it, add it to your watch list if you already are set up on tradingview.com. These are the two that I would highly, highly, highly recommend that you are starting with. And if I had to choose one out of the two, I would say Euro USD. Minor pairs. Now, these don't include the US dollar. Instead, they make up two other major currencies. So you can think of them, people touch and trade on them, but they're like the side pieces. So for example, you have the Euro dollar over the Great British Pound. You have Euro over JPY, GBP over JPY. Now, one thing I will say is I would not start off trading these pairs. There's a majority of traders who did, and they are doing great at it now because they stay consistent with it. I wouldn't necessarily start with it, but if you choose to practice or add this to your watch list, the number one pair from the minor list is GJ. GJ has great opportunities. Now, why to trade the minor pairs? They often offer unique opportunities, but the spreads might be slightly higher and the movement can be less predictable. So as a beginner, my go-to would never be a minor pair, because you got to kind of have a certain eye for them at times when it comes to reacting to news and all of that good stuff. So I would just recommend starting with the majors. But if you did want to really challenge yourself and in the future add one on, GJ, GBP, JPY is the one to go to. As we wrap up, I want to end currency pairs with this. Start with 1 to 2 major pairs. Focus on those easy to follow pairs like Euro USD or GBP USD as stated. They are cheaper to trade, but also more stable and easier to read. Use a demo account first. You will hear me say this often. Practice with fake money until you are comfortable and learn how that pair moves. This one is just something to throw out so you are aware of, but know the base versus quote. So the first currency is the base and the second is the quote. You're trading one against another. That's just a detail for you to just keep in mind. It's nothing extravagant to add on to your strategy. The fourth thing, learn when your pair is active. Every single pair has a busy time. Trade when there is movement. So for example, Euro USD moves during London in the New York session. It is the most volatile during that. So don't get a pair like Euro USD and say, well, I'm going to trade around, I don't know, like 12 o'clock. Well, it's not doing anything. So make sure you are learning when that pair is active and keeping track of that. Study your pair's behavior. Some pairs are calm, others move super fast. So learn how yours acts before you begin trading it. And this is why you learn it in the demo account, but you're also taking note of those things. And just keep it simple. Do not add so many pairs at once. Right now, you are in a space where you do not know what you're doing just yet. You do not need to add a lot of pairs. It will be super duper confusing. And I wish in the beginning I knew this because it would have cut a lot of time. Choose 1 to 2, rock out with those 2, and focus on learning them and not juggling and adding on to your list. Lastly, track your trades. You will hear me say this very often. Get a journal and journal and take note of what you traded and why. Take note of what your pair is doing. As you are learning the currency pair, take note of it. If you see something is about to happen, you notice like around 9:45 is when Euro USD starts to jump a little bit, take note of that. That is something that is going to help you grow in the future. So this is just going to be able to help you spot patterns and grow faster at this thing. And speaking of journaling, if you want something simple to follow along with while learning this, I put together a free guide called the Confident Trader Framework. It breaks everything down step by step from understanding the market to actually taking your first trade. So you're not just watching, but you're actually executing and applying the information in this series. You can download it in the description below. Now we're going to get into what moves the Forex market. The Forex market moves when the currencies gain or lose value. And this happens because of real world events. There are 5 key things that moves the market. So starting with number 1, there's news and economic reports. Big announcements like unemployment, inflation reports can cause sudden jumps or drops in the market. So for example, if the US reports strong job growth, the USD will get stronger. The second thing is interest rates. When a country raises its interest rates, its currency usually gets stronger. So why does that happen? Higher rates attract more investors looking for profit. Those investors make the market move. The third thing is global events, wars, elections, natural disasters, political changes that can shake up the market. So for example, if there's political drama in the United Kingdom, be on the lookout for GBP, the Great Britain British pound, because it may drop. The fourth thing, now it sucks that this is just the way it is, but hey, it's here. Market sentiment. Basically, what moves the market is our emotions as traders. Sometimes traders just react based on the fear and the hype or the rumors that are heard, but not facts. But because of them reacting based off fear, it makes the market move. So this moves the prices as well. And there's a saying in the industry to buy the rumor and sell the news. So one thing about it, if Trump opens his mouth, just know the market is going to move anytime he opens his mouth. So to summarize what moves the markets, the number 1 thing that I want to add on is to check the economic calendar. This shows the scheduled news events that might move the market. The number one thing that you need to be on the lookout for is the high impact folders. These are going to be red folders. And in the description, I realize I did not put this, but in the description below, I will include a link to economic calendars that are good to refer to. This is something that you need to check before getting into a trade every single day. Do not get into a trade without knowing what is going on in the world. Avoid trading right at news at first. In the beginning, you're still learning how the market is moving, what's what. Do not trade with the news at first. The market can move fast, spreads can widen, the price jumps. It is a crazy time to trade news, but you need to just be able you need to be able to just learn and then just trade it when you're ready. Number 3, focus on major currencies first. So USD, Euro, Great British Pound. Most of the news affects these the most. So they're good to watch and learn from. Stay updated with news, but don't obsess. Follow the key news, but avoid checking every little single update. You really only need to be focused on the major ones, the high impact news. News can create volatility. Big news can make the price jump quickly. Now, although this is risky, it can create opportunities too. And that's why I just want to emphasize that in the beginning, just watch how your pair moves to news. Watch how it reacts to news. Watch how the pattern stabilizes maybe 10 minutes after news, maybe 15 minutes after the news. Just don't trade right when news drops. Use the news to confirm your analysis for the day. If your chart shows a trend and the news supports it, that is a stronger signal. Be patient around news events. Sometimes the market reacts in the opposite way than expected. Don't panic. Don't rush trades, even if you think it's working in your favor. Give it a little bit of breathing room to let the news settle, let investors do what they're doing, and let the market get regulated. But just be patient. Keep on learning. The more you watch the news and the more you see how the market reacts to your pair, the easier it is to understand how they connect. In order for you to be successful, here are the top 3 things that successful traders focus on. 1 setup at a time, protecting their capital, which risk management. And the 3rd thing, focusing on consistency and not perfection. As you are starting out, it is so important. And I wish that I was able to get this in the beginning, and it probably wouldn't have took me as long to learn this, but just focus on one thing at a time. I'm going to go back to the currency pairs, 1 to 2 at a time. When you are looking at Euro USD, AUD CAD, you see news was going to be with the Japanese yen. Like when you are spreading yourself everywhere, you are going to find yourself in this loop of confusion, all because you did not take the time to just master one thing at a time. Risk management. You have to be able to manage your risk. As I stated about leverage, not having a stop loss, these are things that will literally kill your account in the beginning if you don't get it in control to start with. All right, so now we are going to move into support and resistance. Support and resistance are the key levels on a price chart where the market often reverses or it will break through. Support acts like a floor. So the price tends to bounce up from this level. Put this on a sticky note and put it on your computer until you understand this like the back of your hand. Support is the floor and price bounces from it. So as you can see in this example, I have the support marked. You see anywhere you see double candles, double candlesticks, and we will go into this more in the series. I do not want to confuse you and overwhelm you, but just know where you see the double candlesticks, likely it is an important key level that you need to be marking. So the floor price tends to bounce from it. Resistance acts as the ceiling, and price often struggles to move above this level. So as you can see here, Another term for this is high and low. So resistance is the high. Price was not getting above that key level. As you can see, price began to go down, also known as form a bearish pattern. These key levels are very important because it helps traders identify potential entry and exit points, and it's a simple yet powerful part of building your trading strategy. There are so many strategies out there, but you will not be able to learn any of them if you do not understand support and resistance. This is literally telling you where the market has been and predicting where it will go in the future. The next thing, it is time to start practicing without the risk. This is the best way to get comfortable without risking your real cash, and you use it to test what you're learning and build confidence. So the first thing you're going to do here is choose a broker. A broker is the platform that you're going to be using to place trades. It is important that you look for one that offers a demo account that fits your needs. Now, not all of them offer demo, but that is 100% okay because here I have the perfect website for you to try. Forex.com. You can trade both personal and demo on this broker account, and I highly recommend it. It's regulated, so you don't have to worry about any of the nonsense behind unregulated and not getting your funds. So the second thing, you are going to set up your demo account. So again, this just lets you practice with fake money while using real market prices. So as you can see in the example I provided here, you'll go to forex.com and it'll show open an account, try a demo account, and it's pretty self-explanatory from there. Even if you feel that you want to test with little money, because it does make sense that some people do, but I would just highly recommend just open the demo account and go from there. By now, you should know the fundamentals of Forex trading, how to read the price chart and the candlesticks, the importance of support and resistance, practicing with a demo account to build confidence, how a successful trader navigates, what moves the market, what is a pip, lot size, leverage, all the Forex key terms, and the currency pairs and the importance of which to choose from. If this video has helped simplify Forex for you, comment below what was the part that began to make the most sense to you. And even if it still feels confusing, let me know in the comments below. I read them and it helps me know exactly what to break down next in order for it to make sense in the next videos. And in the next video of this series, I'm going to be breaking down market structure step by step so you are actually able to start reading the charts and the market with confidence. So if this clicked for you, make sure that you do not miss the next one. If you want a free guide to help you follow along with everything that we are covering, you can download the Confident Trader Framework in the description below. I hope to see you in the next session. God bless.